Welcome to Talk Tickers, the place where we transform dense financial documents into actionable knowledge. Today, we're plunging deep into the world of global LNG shipping. We're dissecting the Schedule 13E3 filing from Company Ltd.
Coolco, right, the big LNG carrier pure play.
Exactly. This document is the full story, the process, the rationale, and the pretty surprising numbers behind their move to go private.
It is. It's a classic going private transaction, but the backdrop here is just full of market uncertainty.
So Coolco, which is dual listed on the NYSE and Euronext,
is being acquired by its majority owner, EPS Ventures Ltd. The mechanics are pretty standard. They're using an affiliated entity to buy up all the shares they don't already own.
For a fixed cash price, effectively delisting them.
Yep, from both exchanges.
So our mission today is to unpack how they got to that final price. We're going to look at the very different financial projections that were being thrown around.
And really understand the market pressures that pushed a major public shipper to say, you know what, we're better off private.
Okay, let's jump in. First things first, the money shot. What was the final price?
The negotiated merger consideration landed at $9.65 in cash. That's per common share.
$9.65.
Right. And for the folks holding shares on Euronext, they'll get the equivalent in Norwegian kroner.
Now, that price, it wasn't just pulled out of thin air. It represented a real win for the public shareholders, didn't it?
Oh, absolutely. When you talk about the premium they offered, it was substantial.
So lay those numbers out for us.
Okay, so if you look at the closing price on September 23rd, 2025, that's the day before the news broke, that $9.65 is a premium of 24.2%.
Pretty good.
But here's the real story. If you look at the 90-day volume-weighted average price, the VWAP,
right,
the premium jumps to almost 38%, 37.9% to be exact.
Wow. So anyone holding the stock for the last few months did very well.
Very well. It shows the deal wasn't just opportunistic. It offered real value over the recent trading history.
And what's crucial for you to remember is that this high price was earned. It wasn't the first offer on the table.
Not even close. The initial non-binding proposal back in August was for just $8.35 a share.
So from $8.35 to $9.65, that's a huge jump.
It is. That's a bump of over 16%. It really shows the special committee did its job and negotiated hard.
And the market clearly believed it. Yeah. You mentioned the filing came out on November 5th.
And by then, the stock was already trading at $9.68. The market had fully priced in the deal closing at that $9.65 number.
Okay, well, let's just clarify all the players involved here. We've got Company, the target, with its fleet of 13 LNG carriers.
Yep. And on the buying side, the main entity is EPS Ventures. They're a big player in maritime venture capital and already owned 59.3% of Coolco.
So they were already in control, essentially.
Pretty much. The deal itself is being run through a couple of subsidiaries, Bounty Ltd. and Apex Merger Sub, which is just a vehicle created to get the merger done.
So why now? I mean, EPS has been a cornerstone investor since 2022. They've supported the company's growth. Why take it private right now if the long-term view for LNG is supposed to be so strong?
Well, the rationale from EPS really hammers on instability. They point to significant challenges and uncertainties in the whole LNG industry.
And they get specific, right? This isn't just vague corporate speak.
Not at all. They're talking about geopolitics, unpredictable tariff policies, huge volatility in LNG prices, and just shifting trade patterns.
It sounds like they just got tired of the public market's short-term focus.
That's exactly it. Being public means you're constantly on that quarterly earnings hamster wheel.
Right.
EPS argued that going private gives them the flexibility and agility they need. They can focus on long-term goals like fleet management and major capital projects without worrying about a bad quarter tanking the stock.
Which brings us to the actual market conditions they were facing. This is really key to understanding the valuation fight.
Yeah, the filing is very blunt here. It says the charter rates, the TCE rates, had troughed.
Why?
A combination of delays, the liquefaction plants, and a short-term oversupply of ships on the water. But the real issue was what they call commercial discrimination.
Discrimination against which ships?
Against their older vessels. Coolco has a mixed fleet, and their TFTE vessels.
Tri-fuel diesel electric.
Exactly. Those were getting hit hard compared to the newer, more efficient XDF and MEGA vessels.
So what does that discrimination actually look like in financial terms?
It's all about fuel efficiency and what the charterers want. The new ships burn less fuel and have better emissions. So customers will pay way more for them.
And the older ones get left behind.
Right. It means when an older TFTE ship comes off its charter, it might get a daily rate that's $10,000 or even $20,000 lower than a modern ship. That creates massive uncertainty in your revenue projections.
And that uncertainty is at the heart of the financial models, which is where things get really interesting. You had two completely different sets of projections.
That's right. You had the company case, which was management's forecast, and then you had the special committee case, which their independent advisor, Evercore, put together.
And I'm guessing they weren't on the same page.
Not at all. The company case was much more conservative, almost bearish. But the special committee's case was way more optimistic about how quickly charter rates would bounce back.
How different are we talking? Give us an example.
Okay, look at 2028. Management's model had those older TFTE vessels earning about $50,000 a day.
Okay.
The special committee insisted on a forecast of $60,000 a day. That's a 20% difference in revenue for a big part of your fleet.
And for the new ships?
Same story.
Yeah.
For the best MEGA vessels, management projected $80,000 a day long term, while the committee used $85,000.
I have to ask, doesn't that feel a bit convenient? That management who works for the majority shareholder doing the buying comes in with a lowball forecast.
I mean, that's the classic tension in any take-private deal. And it's precisely why you have an independent special committee. Their job is to call foul on projections that seem too pessimistic. And they did.
But even with their more optimistic numbers, the valuation range that Evercore came up with was massive.
It was incredibly wide. Using the special committee's own rosy numbers, the DCF analysis gave a per-share value somewhere between $7.03 and $16.05.
From $7 to $16, that's not a valuation, that's a guess. What does that gap tell you?
It tells you nobody has any real conviction about the long-term value of these ships. The $7 floor is the scenario where rates stay low and the old ships become obsolete. The $16 ceiling is, blue skies forever.
And the final price of $9.65 is much closer to the bottom of that range.
It is. It shows that even though the committee fought for a premium, EPS ultimately won the argument that the deal should be priced based on today's risks, not tomorrow's hopes.
So we've got the price and the motivation. But how are public shareholders protected from just being railroaded here, especially since EPS already owned nearly 60%?
The main defense was that special committee we've been talking about. It was made up only of independent directors who had no skin in the game with EPS.
And they hired their own advisors.
Their own top-tier advisors. Evercore for finance, Latham and Watkins for legal. They were empowered to negotiate purely on behalf of the public shareholders.
And in the end, they decided that $9.65 was a fair price.
They did. They recognized that getting certain cash now in such a volatile market has real value.
Now, what about the actual shareholder vote? Was that a hurdle?
Not really, and this is a key point. Because Coolco is a Bermuda company, there was no majority of the minority vote required.
Meaning
EPS, with its 59.3% stake, had more than enough votes to approve the deal all by itself. They signed a support agreement committing to vote yes, so the outcome was never in doubt. The real fight was always in the negotiation room, not at the ballot box.
And in terms of closing, the deal seems pretty locked in.
Very much so. The timeline is for Q4 2025 or Q1 2026. And crucially, there is no financing condition.
So they already have the cash ready to go.
Certified cash on hand. That removes one of the biggest risks that can kill a deal like this.
The only real risks left are lawsuits or a rival bidder showing up.
Exactly. And if Coolco did get a better offer and walked away, they'd have to pay a termination fee of $6 million.
Which, in the grand scheme of a deal this size, isn't a huge barrier.
No. The committee made sure it was a reasonable number. It wouldn't stop a serious, motivated bidder from making a move.
So to recap for everyone listening, a major LNG player is leaving the public markets at a big premium, driven by market chaos and a need for long-term strategic focus. The final price of $9.65 seems like a hard-fought compromise.
I think the really provocative thought here is what happens next. The company's new bylaws will be totally different. Without the pressure of public dividends and quarterly reports, how will they manage their fleet, especially those older TFTE vessels?
They'll have so much more freedom with capital allocation.
Total freedom. They can now make the tough, expensive decisions for the long-term good of the fleet, and that's the whole point of this for EPS.
That is the big question. Okay, it's time for our final segment where we look at the wild possibilities. This is not financial advice. The simple merger arb play here is just boring. The stock is already at $9.68. The deal is for $9.65. There's no meat on that bone.
No. The market is telling you this deal is closing, so we have to look for the tail risks, the low probability, high impact events.
Exactly. The merger agreement gives us two interesting leverage points. First, there's a material adverse effect clause that mentions uninsured damage to vessels from, say, a geopolitical event.
Right. And second, there's that relatively small $6 million termination fee if a better offer comes along.
So here's the outrageous trade. It's a pure volatility play. You could theoretically short the stock now.
Betting on total catastrophe.
A total catastrophe. You're betting a geopolitical shock happens, a bunch of their ships suffer uninsured damage, the MAE clause gets triggered, and the whole deal collapses, sending the stock plumbing below that $7 floor.
That's a dark bet on global chaos. Very high risk.
But, and here's the hedge, you paired that short position with a highly leveraged out-of-the-money call option. Let's say an $11 strike, expiring in February 2026.
I see where you're going. You're betting on one of two extreme outcomes.
Exactly. Either A, the world goes sideways, the deal dies, and your short pays off handsomely. Or B, a rival carrier like Flex LNG or Dynagas sees an opportunity, decides $6 million is a cheap price to pay to enter a bidding war.
And they come over the top with a superior proposal at, say, $10.50 or $11 a share.
Which would trigger a massive immediate spike in the stock price, and that leveraged call option would print a fortune. It's a binary bet on either market chaos or a corporate bidding war.
It's a fascinating way to structure a trade around the specific legal clauses in the filing. A true high-stakes gamble.
It definitely is. That's our deep dive on Coolco, the rationale for going private, and the valuation fight that got them there. Until next time.